Welcome. This is Joanna Bada with the International Model Stock Investment Club. We want to welcome our guests. I will briefly go over how our club works. So we were founded in May 2016. We're a BetterInvesting model club open to the public, and we hold monthly meetings that are held on the third Monday of each month. And then in December, we meet on the second Monday of the month. We use hypothetical money. We are a virtual club. This avoids issues with currency exchanges and taxes. All our meetings are held online, so we serve visitors and guests from around the world. Then our primary role is to be a learning lab. So this allows attendees to learn better investing principles and fundamentals of stock investment using the online stock selection guide, and to learn investment club operations management. We are an international community. We currently have 13 members from the United States, Canada, China, and Singapore. For our meeting, we ask that you look at the agenda in the handout section of the control panel. I'll also have it between sections for viewing online. All visitors and guests will be muted during the meeting and may post questions in the questions section in the dashboard. So this diagram shows you where the questions are and the handouts in your control panel. At the end of the stock presentations, visitors and guests will be unmuted and asked for their comments and questions. So please be prepared to have your comments and questions. This is our disclaimer. It's also under the chat window in the dashboard, the control panels. If you want to see a live copy, I'll quickly go through it. This information is presented for educational purposes only. The views are expressed are those of the participants only. Investors should conduct their own research and analysis before making any investment decisions. Securities discussed may be held by presenters. This presentation may contain items not endorsed by BetterInvesting or the presenters. This meeting is recorded and will be posted to our YouTube channel. Okay, for the next, I'll quickly go over our agenda, what we have for this evening. We will have a treasurer's report hosted by Jay. I will do some November education topic. It's a summary of a ticker talk that was given in October, and then will be followed by our November report. And then we will have an open mic for our guest questions and comments. And then if guests, if they would like to stay for our club business, we will be reviewing buys and sells. We've had a couple member withdrawals, so we'll be discussing reassignment of stocks, and then our education assignments. And then we have a couple motions that are up for discussion and voting. So I will now hand it over to Jay. Jay, do you want me to give you the screen?
Sure, please.
Okay. Let's see. Here it comes.
Okay, I'm presenting Treasurer's report on behalf of Ready. So in October, we deposited $1,500. We had 15 members and $100 each. And we also bought 27 shares of AGIH and cost about $3,800. We also sold Domino Pizza, and we made about $1,800. Current cash balance is about $3,000, a little bit under $3,000. This is our current portfolio heat map, and the size of a block represents the percentage of holdings, which we have the most holdings on IIPR and Facebook. The color represents the gain. The darkest green represents the biggest gain, and we have IIPR, Facebook, Schwab, Disney, Freecore are current our gain. And this is our current portfolio gain and loss percentage. I highlighted the top 3 gain. The biggest gain is IPR, and second is Schwab, third is Facebook. The losers are Vertex, we lost about 15%. iRobot lost about 1%. That is my report for the traders report.
Okay. Thank you, Jay. I
Sure.
will take the screen back.
Okay.
Okay, now we're going to go to our education topic. Last month there was a ticker talk that talked about identifying outliers. This has been a topic in our club that has been up for discussion, and Carol was going to give us an overview, but instead Ann Cunias gave a nice talk about outliers. So I'm just going to give a quick summary of what she discussed. This presentation is what slides that she had included in her presentation. I didn't include all of the slides, but in the agenda are links to the actual video and the complete slide presentation. So this is a summary of what she presented, just so that we as a club have a better understanding about how to identify outliers. Okay, so Ken Kabula and Ann Cunias gave this presentation. Okay, so for the outliers, what we're doing is we're looking at historical data that helps us forecast what might happen in the future. So we apply our judgment to the historical data, and then before evaluating the historical trends, we remove the irrelevant data. So those are the outliers. And then, so what Ann and Ken cautioned is that we should pay particular attention when eliminating data from the most recent 1 or 2 years. And then again, irrelevant pieces of data are also known as outliers. So there are 2 types of, so looking at the first page of the SSG, you'll notice that there's lines for sales, EPS, I believe that's pre-tax profit, and then, so there are 2 types of outliers. A one-time event, which in 2020 was the whole on the left, is a COVID reflection. And then on the right is early rapid growth for a company, usually a small company that's having rapid growth, and then it starts to level off towards the right. So with early rapid growth, you want to, so it's normal for a company to slow down as it gets larger. So what we want to do, and if we keep those early years where the rapid growth was occurring, this can skew the measurements and give us a false picture. And typically that's one that's too optimistic. So if the company's growth has been slowing down, then we want to remove that early data from the trend line. So here's an example where it's showing historical sales growth at 11.9%. Includes the early, early, I guess, steeper curve, and then historical EPS growth 26.5. If we strike out 11, 12, 13, 14, 15, 16, we get a much more relevant growth as the company starts to level out. So that's one thing you want to take in consideration for a rapidly growing company. And then the other area is a one-time event. So you want to look at, so when you see something that's a spike or a dip, you want to look and see what's happened actually with the company. Was there an acquisition? Was there a sale part of the company, a litigation expense, changes in the law? We saw that with the tax in 2017. So it can't be determined whether or not the event will repeat just by looking at the graph. You have to look a lot deeper. So before removing the outlier, I know we've seen it before and we just strike it out because it disturbs the line. But you need to determine the cause of the anomaly, especially if it occurred within the last 4 to 5 years. So if it might reoccur, then it's not an outlier and you should leave it as it is. So here's a caution for novice investors. Companies with severe dips in the most recent 5 years should be avoided. So that's probably something we should look at closely when we're looking at our stocks. And then you should put them on hold until you have enough knowledge about what the company is experiencing. So how to check the one-time event. So check the 10K. I really like the item 7 where they have the management discussion. You'll find a lot about what's going on with the company there when in item 7. And then also check with press releases. So I check with those. And then if there's a EPS spike, you'll notice here in 2016, its research revealed that this company is still part of the business boosting the EPS. So it's not tracking with the sales. It's actually bumped up. So if you remove 2016 as an outlier, you get a more reasonable forecast, which is more conservative. And what you do is you do your projection starting point at the trend. So in this case, the future EPS is estimated to be 9.41. If we had not removed the 2016, it would have been 12.45, and this is actually something that happened in the past. So the actual EPS in 2021 was 10.36. So that was by removing that 2016 and doing this projection starting point on the trend, that was a more accurate portrayal of what happened with this company. So with this, here's the dip. Sales were down in 2020. This is a COVID related. Pre-tax profit and EPS were way down. And then, so this company was severely affected by the pandemic. The most recent quarterly numbers indicate the company may be getting back on track. So you see how it popped up here. So what you want, okay, so that's the front page. So on the second page, we're actually looking at our PEs. So we've often looked at eliminating high or low PEs that are significantly different from the other values. If EPS drops to a non-recurring event, the low EPS will inflate the PEs for that year. So high PEs and low PEs should be evaluated separately. You may decide to eliminate a high PE for a year, but keep the low PE. So here's with the unusually low EPS in 2020 made the high and low PEs much higher than the other historical PEs. So if the unusual EPS is the result of a one-time event, the PE should be removed from the average calculations. So that's showing right here what's happening. Okay, so once we remove those outliers, the average PEs are more reasonable. So this is a summary. Apply judgment to the historical data on the SSG to help form reasonable expectations as to what will happen in the future. Data that does not represent the true performance of the company is considered to be irrelevant. That's when we strike those out, and they're considered outliers. Before removing any dips or spikes from the sales or EPS data, be sure to understand the cause and verify it was due to a one-time event. So I know in the past, we've just seen that they look like outliers, so we just struck them out, but we need to do one additional step and look into why this occurred. So that's looking at the item 7 in the annual report and looking at the quarterly reports. So apply extra caution removing data from the last year or two, and novice investors should avoid companies with severe declines in EPS within the last 5 years. Okay, so that's my education topic. Oh, and so if you want further information, the summary of the presentation that I just gave is linked here. The complete presentation is linked here, and then the Ticker Talk video with Ken and Ann is linked here. And also, you can go onto the BetterInvesting website, and they also have, under the Ticker Talk section, there's a link to the video. Okay, so
Joanne,
Hanny,
I have a couple questions.
Sure.
So did they say that 2020 is considered an outlier?
Yeah, well, if some companies weren't impacted not as dramatically as the one, an example in the, so I wouldn't strike out every 2020 number, but that's why you need to take a look and see, the company will identify.
So if it was COVID related, can we automatically call it an outlier? I guess is my question.
Well, I would make sure to confirm you need to confirm through the management discussion. It will be able to describe that in the management discussion. But as long as you can confirm that it's actually impacts from the COVID, yeah, I would go ahead and strike it.
Okay.
Does that answer your question?
I think so. Yeah, I guess it really still depends. And then I guess my other question is, when you talked about a company going from a small to a large, how do you quantify that? Like, how much is a lot versus, if you can't answer, that's okay. Yeah.
You saw it in the graph. Well, first you get the visual. It was really flattening out towards the end. You know, it's like creating kind of a rainbow shape.
Yeah.
So then that's, when it's starting to dip like that or flatten out, then you don't want to include the early years where it was quickly rising, because that can skew your projections. So
are we comparing the size of the revenue? When you say like a small company growing fast, like 1 billion in sales is small, so a steep graph is fine. But then is the point you start counting the steep graph as an outlier is when the company grows to greater than 10? You know what I'm saying?
Well, yeah, I know what you're saying. Well, I think it most often occurs with small companies where they have the steep growth in the beginning and then it starts to flatten out. But I think any company, I don't think we should just base it on size. We should just base it on how the company is performing. So if it's has a real fast growing rise in the initial years and then it just starts to flatten out, that's when you want to start looking more closely at deleting those early numbers.
Okay. Thanks.
Okay. Okay.
This is Carol,
Hanny.
if I may.
Oh,
oh
hi, Carol. How are?
I would say hi.
Should I introduce you? Yes.
Sure.
Okay. Hi, this is Carol Stein. She is kindly mentoring our group. We really appreciate it. She's been really helpful. Actually, the outlier section was something that she's been helping us with. So go ahead, Carol.
I would say in general, for every company that I'm studying, I like to always look at what the growth rate has been in the last 4 or 5 years. So I usually do that quickest by just, crossing out the first couple of years. Sometimes I put them back in, sometimes I leave them out because I decide that the last 4-year growth rate is better.
You mean more accurate more representative of where the company's going? Is that what you're saying?
More than likely, yes. Yep.
Okay. All right. Thank you. Any other questions or comments from the members? Okay. Hanny, I have F&B up for the, do you want me to show it? And you just want to talk to it, or do you want to bring it up on your own screen?
I can bring it up on my own screen.
Okay, I'll give you the.
I have two screens, so just tell me which
You want me
one.
to- Not that one. It's the
Paddleboarding, we're seeing.
paddleboarding.
Oh, it's a
Is that your
catamaran.
boat?
There you go.
That's my future boat. Yes. Okay, so all right. So Franco, Nevada, just for in case we have some guests that are not aware, it's a mining and streaming and royalty company, which means that they don't actually produce anything. They provide capital to mining projects in return for either a percentage of the production or physical metal. So, for example, they could loan Barrick Gold, a couple of $100 million, and in return for that, there would be some agreement, and they would get so many ounces of gold, or they could get a percentage of the profit. So they have little risk in terms of operational risk, but really the biggest risk is going to be related to commodity price. When gold and precious metals commodity prices are high, most of the miners will produce a lot, and so sales for Franco-Nevada revenue will go up, but they have very little control on that. It really depends on the agreements. So anyways, you can see here the SSG, it's not so much up straight and parallel, but definitely going up. And I used for my forecast for this quarter, I'm doing the Q3 results. I've used conservative 6% earnings and sales and earnings, and I did take out some outliers. Their average PE ratio is around 70, and that's with these outliers removed. Current PE ratio is 41.4, and so using those numbers and looking at, say, a 20% decline. I've also looked at the 1-year chart and looked at where the low price was on the 1-year chart, where there was some support. So around 120, 123 as a low price made sense. And if you run all these numbers, you get a 3.5 to 1 ratio. Now, if you look at the member sentiment under research here, you'll find that it's a little bit more optimistic. So, and that could be very well the case. There's a lot of talk right now about inflation. There's a lot of talk about tensions with China, printing of money, and so on. And all of those scenarios would lead to a higher gold price. An interesting fact about, you can see the numbers here, most recent quarter and the trailing 4 quarters numbers are pretty positive. The gold price in Q3 was actually lower than Q2, but Franco-Nevada has a little bit of diversification in that they also own oil and gas rights, and with the recovery in energy prices, that boosted their bottom line. So even though the gold price was a little bit lower, the spike in oil prices helped them out quite a bit. So pretty solid company, very conservative. There's no debt on the balance sheet, and the PE is below the long-term average, 41 currently versus 73. And there's some tailwinds, like I said, with some of these macro conditions that people are talking about. So as a hedge, I think we should continue to hold this, and I would recommend increasing the size of our holding to maybe around 5 to 7%, just as a hedge against inflation and everything else that some of the other issues that are popping up. That's it. Any questions?
What's our current holding? 2% or something like that? 3%?
Yeah, I can't remember exactly, but I think it's 2 or 3%, something like that.
We were going to try to get everything up to a minimum of 5, right?
5, yeah.
Yeah. Okay.
So I have a question about your estimates. Why did you pick such a low estimate when the 2 years, I think you've selected 6% and the 2 years over 20%?
Yeah, so I think so the only way that these guys can increase their sales significantly is, well, there's two ways. One is that the commodity price could go up a lot, and that'll change their sales number significantly. The other is if they buy into more projects, and that tends to be a bit of a slow process to bring new projects on, because you have to go and negotiate, find out which are the best projects. There's a lot of uncertainty around gold reserves and estimates. So some of the projects that they could buy into may not work out as well as they may have estimated. So taking all of these things into account, I just thought I'd be conservative, and even with that conservatism, we're looking at a 3.5 to 1. I could easily have made this look like 5 to 1 or 6 to 1, but I just wanted to sort of take a cautious approach, and even with that, it looks like a good buy.
Okay, thank you.
What's the return at the bottom?
The return is it says 11.9, but again, that really depends on. I think if gold went up by a couple of $10-20 an ounce, that return would easily get up to 15 or more.
Okay.
But there's two reasons to hold this. So one is definitely for the return, but the other is just as a hedge, because a lot of the things that we're holding right now could be impacted negatively by some of these macro conditions. So holding gold in a portfolio is not a bad thing as a hedge.
Any other questions for Hanny?
Mm-mm.
Okay, should we move on?
Yes.
Okay. Isla, are you here?
She is.
Yes, I am.
Do you want me to bring up the screen
Yes,
with
please.
your, okay, hold on a second then. Okay, go ahead, Isla.
Okay, so good evening, everybody. This is a report on Biomarin, which is a biotech company in California. They specialize in seeking treatments for very rare diseases, extremely rare diseases. Most of the diseases that they target are PKU and some others that really don't have a lot of people who have these problems. However, when they do have the problems, they have them lifelong. So once a treatment is discovered or used and it's safe, it is something that they generally have to take for the rest of their lives. So the addressable markets for each of the diseases that they are targeting are very, very small. And as you can see, they don't make a lot of money. They have had several commercially successful medications in the past, but recently, in the last year and a half or so, there's been generic competition. So they're getting less money for some of the PKU remedies and other remedies that they have. They have some other things in the pipeline. They have very, very significantly heavy and healthy pipeline of things going on. They're trying to expand the number of treatments for PKU and for other diseases, and they're also trying to move into some new areas. They had some candidates that were up for FDA review and approval, and they were expecting, in fact, a lot of analysts were also expecting that the FDA would give them the approval and they could start the process to market these and bring them to the public. But what the FDA did was ask them to bring in 2 more years of data. So a lot of their the money that they would have made has been postponed. They will probably get this FDA review sometime in 2022, so they may be able to get some of the drugs by 23. Again, they are not yet earnings positive. They have in the past had earnings positivity, but that was really more of an accounting measure than the actual money that they were making. And there is also some issue with whether or not some of the insurance companies will be willing to pay for these medications because they are quite expensive. This company has also been kind of had a bad rep in social media for sometimes not allowing certain people to get into their clinical trials and not have access to the medications. So right now they're kind of just waiting on the FDA to come through with this review, and they can get a couple of, they have 2 other drugs. One is for severe hemophilia and another one for PKU, and they're waiting for the review on that, and hopefully they can bring those to market, and hopefully they will begin to be earnings positive. So, you know, it's kind of a, it's not a, it's what BI calls a non-core holding, and it's not something that is giving us a lot of returns at this point. It's more hope that they will get these drugs, they will bring them to market, they will be successful in marketing them. They have been successful at marketing drugs in the past. So there's a lot of faith that they will be able to do that again with the new medications that they have and with other things that they have in the pipeline. So because of the positivity around them, you can see that my estimates are pretty elevated, but that really does speak to the positivity of the analysts and the idea that when they do hit on a medication, and as I said, they have hit on several in the past, they do make a good go of it. And again, these are medications that patients have to take. It's not something you take and then you get better. It's not like a cold. You take this, you get better, and you move on. They have to take these medications. They have to take them usually lifelong. So even though the addressable market is small, it is consistent. So my suggestion would be actually that, you know, we could hold it, we could get more of it. It kind of depends on how the club feels about putting some more money into what is essentially a non-core holding. Any questions?
Hi, Isla. It's Hanny.
Hi.
Do you know, I guess, what stage is the clinical trial for this drug?
The clinical trial, the 2 clinical trials that that they were hoping to get the FDA review on were in phase 3. So they were very, very close to being marketable. They have lots of other things that are, you know, preclinical, and some are in phase 1 and phase 2, but these 2 were phase 3.
Okay. And are there any other sort of phase 3 trials that they have in their pipeline, or are they focusing just on these 2?
Well, they're focusing all their energy on these 2 because these are the ones that were furthest along in the process. They do have a number of others that they're working on, but again, they're in phase 1 and phase 2, so they're just trying to figure out if they're safe, you know, and what the side effects are.
Okay. And do they spend like a significant portion of their revenue in R&D, I guess, or is it?
Yes, they do. But they also have, yeah, they do. They spend quite a lot of money in that, but which is, part of the reason why they charge so much money for their medications once they do get them to market. And also, again, one of the reasons that some of the insurance companies may be balking at trying to pay some of these high prices. But I think that's a moment of the times that we're in the past, maybe 5 or 10 years ago. Whatever the drug company asked for, the insurance company was willing to give. But now there's a little more negotiating going on.
Okay. Do you know if there's anybody else that's working on similar drugs that could be sort of competition?
They're generics. The generics, they're not people who are working on first line medications. They're pretty much first to market for the small conditions that they work with. But a lot of the generics that have come to market are basically based on what they've already put out. So there aren't any others that are giving significant competition at the moment in first line medications.
Okay, great. Thank you.
Any other questions for Isla? Okay, let's Megumi, Facebook, do you want me to bring up the SSG, or do you want the screen?
Oh, you can bring it up.
Okay.
Is it Facebook or is it Meta?
Well, Meta doesn't start till Q4, so technically
Okay.
December 1st. But Facebook, I knew going into this that we weren't going to purchase any more Facebook because we're way overloaded on our large size companies, and Facebook is our largest holding with 14% of our portfolio being held in Facebook. But I did want to go over some of the major news that Facebook, they've been in the news a lot lately, so just wanted to go over some of those. First, there was the whistleblower, Frances Haugen, who accused Facebook via leaked documents of prioritizing profits over public safety. That's still playing out. I sort of feel like that's what corporations do, right? They're about making profit. So that's still going on. They had that platform outage for about a day back in early October. The cause was a router issue, and they fixed it by resetting servers. I don't know if that's ever happened before, but it caused the share price to drop about 5% a couple of days following, but it's back up again. They canceled a 10-year-old facial recognition technology, indicating that the benefits weren't worth the risk to privacy. I was a little bit surprised about that. And then the big one is that starting next quarter, Q4 of 2021, their financial metrics for Facebook Reality Labs will be separated from the family of apps. So, and Facebook Reality Labs is their virtual and augmented reality divisions. And they're doing this because they're going to be investing a lot of money into this division, and they want to provide more transparency to shareholders because they are anticipating an overall reduction in operating profit by about 10 billion in 2021. But what this will do is that Facebook will then own their operating system rather than relying on, say, Google or Apple's platform for their services. And the new ticker symbol will be MVRS. So despite all the negative news that Facebook that's been going on, the price hasn't been affected very much. And the daily and monthly active users were up 6% year over year. So, I think 3.5 billion people use at least one of their services once a month. That's about half the world's population. And Facebook is also, they're used to fighting these regulatory battles now. And so the onus will be on the prosecution, and I'm referring to Frances Haugen. The onus will be on the prosecution to show that Facebook had the intent to do harm, and also that they were reckless. And I don't know. I'm not, I don't have Facebook. I'm not a big fan or one way or another, but I just feel like that's going to be hard to prove. But the price is down from the previous quarters and projections are positive. So it is a good time to buy, but I don't think it's right for our portfolio. In the earnings call, Mark Zuckerberg's view was that in reference to the whistleblower is that, Facebook has to, they need to balance competing social equities. For example, free expression with reducing harmful content, privacy versus supporting law enforcement, enabling research and interoperability with locking down data. And he says that he has repeatedly asked for regulation to provide clarity on this because he doesn't feel like that, Facebook and other tech companies are the ones that should be making those decisions. They're on track to spend $5 billion on safety and security in 2021, which is more than any other tech company, even adjusted for scale. And, third quarter, they had solid results. Ad revenue was up. Total revenue was up 35% year over year. So non-ad revenue was up almost 200% because they released the Quest 2 sales last holiday season. EPS increased 19% year over year. They hired more employees. They're up 20% in new employees, mostly in the technical area. I mean, everything's just plus, 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 plus. On the headwinds, they're pretty much the same as always. Regulatory is one. The macroeconomic is, the macroeconomy is the other one. As the economy opens up more, people are purchasing more things in person versus online. So, e-commerce has slowed down. The global supply chain issues, which reduce consumer business with less, which reduce consumer business, lessen the appetite to generate demand due to lack of inventory, which in the end impacted advertising spending, which is how Facebook makes like 99% of their money. And then there's also the labor shortage that's causing, I don't know, I'm sure you guys have all noticed everybody's hiring. They can't find anybody to work, especially like restaurants and stuff like, so they're shutting down their hours. At least I see it everywhere in California. So there's the regulatory, the macroeconomy, and then the iOS 14 platform changes, Apple's platform changes, which started in Q2 but hit critical mass in Q3. And they saw this coming, and it has negatively affected their business, but they anticipate that they'll be able to navigate it. And they did say that if it wasn't for the iOS 14 platform change, they would have seen positive quarter-to-quarter revenue growth. As far as forecasts go, the analysts are pretty positive. Value Line says that the stock is, this is quote, this stock is ranked to outperform the broader market averages for the coming 6 to 12 months. These shares offer attractive long-term appreciation potential. Value Line ranks the internet industry as #1 in terms of timeliness and quote, highest ranks for year ahead relative price performance. Looking further out, we anticipate healthy growth in revenues and earnings for this group from 2022 onward. BI projections decreased slightly, and Yahoo and Zacks had relatively the same projections to slightly lower numbers. So the bottom line is, I think it turned out to be a buy if we go through the SSG, but we also own Disney and Alphabet and Amazon and Schwab, which are all large companies. So I think it's more about how are we going to balance our portfolio by reducing our holdings of the larger companies. We could sell some shares of Facebook but I don't know. I know we didn't have a portfolio study because Tom isn't here, but that's pretty much it. That's really all I have.
Hey, thank you, Megumi. Any questions for Megumi?
Are
I
we?
have Megumi,
Yeah.
they're spending a lot of money on this Metaverse,
Yeah.
and it seems that will require a lot of talent and very specialized talent. And it's from what I understand, which is not much, but it's AI based. There's a lot of AI involved. Tesla is hiring AI engineers like crazy, other Google, Amazon. So what, do you think they'll be able to get the talent required? Because I see that as the sort of the rate limiting step for them to
Yeah.
transition their business.
So
And
I
sorry,
think
and
so.
especially like with some of this negative publicity that they're getting at the moment.
Yeah, I mean, I always expect the share price to fall based on all this negative press, and I don't know about what, specifically how Tesla and did you say Amazon are using AI, but what Facebook is trying to do is to create this ecosystem that allows the social experience of being in the same space as the person you're interacting with. So whether you're in a meeting or just talking to friends. So, I'm an architect. So the way, if I'm imagining this correctly is, I bring out a set of drawings for a client, and even if it's like a model, three-dimensional model on a computer, sometimes it's hard for them to visualize what it is. But if you could imagine putting on a headset and walking through the design of the building, pointing out doors, or okay, how about if we put a window here, I think that's the sort of technology that they're after.
Yeah, I mean,
so,
I've used that technology in the lot, before I retired, where you set up these 4 posts and you put on VR glasses and you can walk through the thing. I think this is more sophisticated probably, and you could do it over the internet, I guess, and you can share it. But I guess my point is like a lot of these companies, everybody's getting into AI, and it seems to be the next big thing.
yeah.
But the talent pool is very limited, and I'm just wondering how these companies are going to be able to compete with each other and get the talent that they need to realize their growth potential.
Yeah,
And
well,
I just, with Facebook, I just because it's been, there's been so much negative publicity that the Social Dilemma, I think, was a documentary that on Netflix and a few others. Are these guys going to be able to compete? Are they going to be able to hire versus some of the other big tech giants?
yeah, I guess that remains to be seen. I mean, they've been around longer than Tesla, right? I don't know about Amazon's probably been around longer, but like half the population of the world uses one of their services, like 3.5 billion people. It's very accessible to people, and their focus is on small to medium, as far as commerce, their focus is on small to medium-sized companies. So, and the way I see it, they're always evolving. They're always coming out with new products, and their focus is going to be on videos, both in I think it's Instagram, and then what was the other thing? Oh yeah, so they realize that they're sort of losing in the younger, which means under 30-year-old age group. So they realize that, and they're going to try to turn that around. So they're it's, they seem like they're doing all the right things.
Megumi,
Yes.
Isla, I have a question. So just as a comment, I read an article the other day about some of the techie type people may be willing to take jobs with certain companies. They just don't want to tell anybody they work for them.
I get that. Right?
So
Yeah.
there's that. But my question is about the $10 billion that you mentioned. Did you say that they mean that they would make $10 billion less, or they're going to spend $10 billion?
It will reduce their operating profit by 10 billion in 2021, is what they said.
And that was because of the investments?
Yeah, in VR AR, because they're going to dump
All right.
so much, so that's why they want to separate out the apps from their what they're calling Facebook Reality Labs division, so that
Right.
the shareholders can see clearly what's happening.
Right. Okay.
Yeah.
Well, I know just in reference to some of the things that have been going on with Facebook, I know that there's a company called Cognizant, which is also a tech company, and they were doing some work for Facebook on the backside content level, but they were getting a lot of pushback from their employees about some of the things that they had to see and do. Cognizant was pushed into terminating that contract, which kind of negatively impacted them. But that's the kind of thing that goes on in that world when people are posting all kinds of different things. Somebody has to regulate that or has to look at it and make sure it doesn't violate the terms of service and that kind of stuff. And so Facebook is just kind of caught in the middle there.
Yeah, I feel this. Yeah, I feel the same way. Same thing that's sort of going on in the cryptocurrency industry, right? It's like, it's just going to happen. So if government wants to, regulate it, they gotta jump in and do it.
Well, they got to first learn what it is, because
Yeah, that's true.
if you listen to any of the congressional hearings in which the techie CEOs testify, these senators don't have a clue what kind of questions to even ask. And when they do hear some jargon, so they have no idea what they're talking about. So, they need to get smarter people in their offices who really know how this stuff works, and then they can try to work through how to regulate it.
Yeah, I totally agree.
Thank you.
So what apps do younger people use these days if they don't use Facebook, Instagram?
I think it's Snapchat.
They use WhatsApp, they use Discord, they use a lot of different things, but she's correct, and Facebook is correct in that younger people, like teenagers, are definitely not on Facebook. Absolutely not on Facebook. And there's a group of people that are on Instagram, but then there's a whole other group of people who are not even dealing with Instagram. So the younger people we get, they're going to migrate to other kinds of platforms. And if Facebook bought WhatsApp and they bought Instagram and they lived on that for a good while, but they're going to have to try to find some other way to connect with people who are, 10 and 11 years old now.
Yeah. Things are evolving rapidly.
Yes, they are.
I have that problem with my kids. They're all different ages.
Yeah,
they
kids
use different
evolve rapidly
platforms.
too. Yeah.
I can't keep up.
You can't. We can't keep up. We can't, because we're too busy thinking of other things. They're thinking of things to do. We're trying to figure out how to feed them.
That's right.
Okay. Thank you, Megumi. Let's move on. Jay, Freecore.
Okay. I can.
You want the screen?
Yeah, sure. I will take the screen. Yes.
Okay.
Freecore. Okay. So Freecore has another strong quarter. Actually, the last 3 quarters, they all company has raised their guidance to 20% next year. I wasn't going to change anything on SSG, but just for the curiosity, based on the projection I had, I just want to see where they are right now. And also, based on what you said, Joanne, about Outlier, I was looking at, okay, what should we, obviously 2020 for them is an outlier. And I would see, so if I cross the outlier, I need to use the trend, Joanne?
That's what the presentation indicated.
Okay. So I was just, I just learned this. I would just play around to see what this is at. And then, so this company is doing well. They are definitely rebounding. They did it better than 2020, year over year ago, and they did it better than 2019. So based on looking at SSG, alone, the company that it shows in a buy and actually, wait, hold on. If I change that, so I don't want to cross out 2020 because that messed up the upside down ratio. So I crossed the outlier in a high PEs and I crossed out one low PE. And wait, that is not right. Oh, okay, I know what went wrong. The trend. Let me do one more time, see if that changes things. Okay, 5.9, that's a bit better. Because this projecting point will change the upside down ratio. I feel like I don't like the 6:1 ratio. I felt like it's still pretty high. But however, this company is pretty healthy and strong. They have generated about 300 million free cash flow this quarter, and the last quarter I talked about they acquired 2 companies, and they have been doing very well. And also I want to show the rebound on the lodging. The last couple quarters, especially 2020, their lodging business revenue was negative, was low. This quarter has been went up to 40% in lodging business, as you can see the comparison a year ago. And the corporate payment went up in the fill and a toll. So their organic growth is about, this is the organic growth breakdown. I think the total organic growth is about 17%. Yeah, it is here, 17%. So this just shows their breakdown in different segments. So even though assets shows buy, I will say just continue hold. I can show you the quarterly data. It wasn't messy in 2020, but they are they're trending up now, starting in 2021. That's it. I don't have I cannot find any positive and negative news, but I only know that they talk about the, they did it well and why they did it well in what area. So I just recommending continue hold. Oh yeah, Henny asked me a question. Henny, you had a
how much do we own, Jay? Do you know?
how much do we own?
4.2%. But I also see, didn't we sell Domino's? I still see Domino's listed here. But Freecore is 4.2%.
Oh, probably because we didn't do a valuation, maybe.
Oh, okay.
You have to run a valuation every month.
Oh, okay.
But yeah, so
Okay,
roughly.
so we're getting pretty close to the 5%. So yeah.
I don't think, yeah, it's a medium-sized company. It's still pretty healthy. Yeah, I would say not buy anymore, just continue hold.
Because we need to bump up our medium size company holdings. So, okay.
Right. Also, in January, we will do a deep dive for technology company. So this is one of the companies that we can reevaluate again in January.
Now, do you consider this a technology company, Jay?
This is yes, this is a technology company actually. Whatever they're doing, they have a software for accounting for the payment, auto payment, accounting payment, all the cards, right? The cards they're using is all technology based.
Yeah, but I see like Freecore more like a Visa or a MasterCard with some
finance
bricks and mortar, like because don't they have like some hotels for truckers and that sort of thing?
Oh, good question. So I really think it's an information technology services, right? So depends on who do we go. The category, if we go with what this not BetterInvesting, what is it called?
Morningstar.
Morningstar, yeah. If you go with Morningstar, it's categorized as a technology. I have a
Okay.
feeling if we go to value line, I don't think so. I don't think it may not be as a technology. I don't remember what value line categorized as. Let me have a quick look.
I think you're right. They do own, they just recently bought a company of small hotels that cater to people who are displaced,
Hmm.
Yeah.
so they can put them up. So yeah, so they own stuff like that. So even though they're listed as a tech company, it seems like branching out a bit.
Can I tell
Yeah, it
from
says
the
it
value
says,
line?
BI says technology.
Yeah,
Industries.
for
Yeah.
value line,
Yeah,
am
yeah,
I
that's
able to tell
Morningstar.
from this report? I can't.
Yeah, it should be on there somewhere.
Come down, come down. Where is?
I know
Well,
we'll do
it's
research, it will tell you, but in here, I cannot tell if this is, what industry is this?
well, it's in their name.
Yeah,
Go to
Freecore
the top.
Technologies.
Yeah, I know.
Go back up to the
I
top.
can, yeah, this is the top. I can do a quick look when you guys present something else. I can look value line, see what they, what
Okay.
the category is,
Yeah.
the sector. Yeah,
Okay.
I don't know how to look from this.
Should we move on?
Yes, move on.
Okay.
I mean,
Christopher, QLYS, do you want me to bring up the?
Sorry, can I
I can-
ask a quick question? Sorry.
yes.
I was just looking at the chart, and the stock is down quite a bit from, it was a high of 318 in March of 20, and it's down to like 241 right now. Do you know why it went down so much?
Right, I know. Actually, I was going to address you that question. You text me. There was a 15%. I couldn't find any negative news about this company right at this quarter, and so the earnings come out November 4th, and then the price went down. I was wondering if it's sometimes earnings right before the earnings come out, the price will drop, and so that they felt that they may not meet the expectations. This could be one reason. Two is the market was down, and I was just browsing just to see what was going on. I'm looking at Market Watch, and overall the market was down. I couldn't figure out for this particular company. I couldn't figure out the reasons that the price got dropped.
Okay.
They do say outperform market despite losses on the day, and I just I don't see any negative news
Right.
to drag the price.
Are you trying to say it might be a good time to buy?
Yeah. Yeah.
Yeah.
Yeah,
Yeah.
for individual, for on a personal portfolio.
Yeah. That's what I was looking at.
Mm,
Okay. Thanks, Jay.
okay. Yep.
Christopher, do you want me to bring up the
I can share
SSG,
my
or do
screen.
you want to share your screen? Yeah. Okay.
Do you guys see the SSG?
Yes.
Okay. Yeah. So we can first look at the SSG. So it has been increasing for the past 2 quarters, but there was a dip in 2021 Q1, as we can see here, and this was because their CEO was sick, so they had to take money out of the company to pay him back in terms of like equity, and yeah, so that's why there's a dip. So this is a one-time thing, so I consider it as an outlier. So otherwise, it's it's experiencing pretty steady growth, and we can also see that in the quarterly data. Like when we look at the sales, it's always like positive for all the quarters, and yeah, and let's look a little bit at the different metrics. So my sales growth projection would still be like at 12%, same as last quarter, and the 12.6% for the EPS growth projections comes from just using the preferred procedures. And yeah, and compared to last quarter, the trailing 4 quarters rate for both sales growth, PTP, percent change, and EPS growth is better because we're farther away from when the payout happened, right, for the CEO. So the rate is the trailing 4 quarters rate is increasing. And yeah, and the current price PE from the SSG is 76.4%. It's a little bit high and overvalued in my opinion, because the average PE is only 50.4%, as we can see here. And yeah, and it has a relative PE of 152%. It has an upside downside ratio of 1 to 1 and a compound annual return of 3.4% using average PE. And if you use a forecast high forecast PE, it's 9% annualized return. And yeah, and what the company, so QLYS is a cybersecurity company. What its primary product is VMDR, which stands for Vulnerability Management Detection and Response. And this they started their product like a while back, but then it's really started gaining traction over this past year. So last year, Q4, it had 19% of companies using it, and now it has 32%. And it went from 90% to 24% to 28%, and now it's at 32%. So it's experiencing pretty steady growth, and it's expected that this should keep increasing, because especially because QLYS is like the best at this particular type of cybersecurity solution. And
is that US numbers or international?
I believe it's US numbers. Yes.
Okay, thanks.
And something else to note is that, so remember that, so I recall that I did mention about like the CEO having to retire, right? So they also have a new management team, and so they have a new CMO, so Chief Marketing Officer, Chief Product Officer, and then a new CIO as well. So this quarter has been like a good indication in terms of like their management team, and it seems like it shouldn't be too big of an issue transitioning from like the old management team to the new management team. So I think that's mostly it. But yeah, so I still recommend a hold because it's not very spectacular like returns. However, I do think the company is still doing well, and it's steadily growing at like 12% a year. Yeah.
If you go to your first tab and then hit the trend line, but how does it change the now that we're experimenting with this, does that change the bottom line?
It goes from like this to like this. So it just continuously on this trend. It's pretty similar in my opinion.
Okay.
Yeah.
Got it.
Yep. Are there any questions?
I'm looking. Is it a medium-sized company? I can't. I'm gonna.
It is a medium-sized company.
Oh,
yes.
it's already medium. It was small, I think, when we bought it. It grew already.
Is it? Let's see.
You go to company, highlight the company.
It's a small. It's still small.
Is it still small?
The
Yeah.
363 million. Yeah, so small. Less than billion. The sales 363.
And it's less than 3% of our portfolio.
Christopher, did they use AI to identify threats, or is it?
I didn't read about that from their presentation, but maybe. Let me take a look.
I have a feeling they got to do something with AI.
Yeah, I think.
Yeah.
Should we move on?
Before move on, the Freecore for value line, its industry is a financial services. So Hen, you're right. They do compare with American Express company and Visa. They sell value line, financial services.
But in our portfolio, the way our portfolio is balanced, it counts as a technology.
Yes.
Yeah.
Because we go with Morningstar.
Yeah, we go with Morningstar.
Mm-hmm.
Okay, do we want to move on?
Yes.
Bob, Piero, do you want me to bring up the SSG?
Well,
Or do
okay.
you want the screen?
Okay, give me the screen. I'll do that.
I'll give you the screen.
Okay. Okay. Now, show my screen. Okay. All right. Let me get over there. Why? Oh, there it is. Okay. Oh. Okay. This is my SSG for Schwab. That's right. So the price right now is about $81.20, something like that. Anyway, these are sales. Sales have kind of jumped up here because we're coming out of an artificial kind of low from the year 2020, the coronavirus pandemic, right? Schwab, most people think of Schwab as kind of a brokerage account because it's giving free brokerages. It was kind of the a rebel way back in the 70s. It started that kind of move, lowering brokerage fees, transaction fees, trading fees. Anyway, but it's also a bank, and banks are really dependent upon their customers. And so when your people are staying at home, they're not interacting too much with the bank. But anyway, these are sales. They've jumped up. This is because, save and error. What is that? Recording path specified and recording setting does not exist. Click settings to choose a new save in location. Can I cancel that?
We don't see what you see.
Oh, it says here, a save an error. The recording, this must be from BetterInvesting. Okay, the recording path specified in recording settings does not exist. Click settings and choose a new save in location. Okay.
Piero, do you want me to just show my screen?
Yeah, show you.
Okay.
You show the screen. Okay, let me do this. Okay. Okay, so the sales there, that's just a jump up because Schwab bought TD Ameritrade. So this is an acquisition right there, that jump right the last 20 to 21 in sales. Okay, this kind of trend usually lasts for a little while, then it kind of begins to return to normal. Also, pre-tax profit, same kind of jump. Earnings, the same kind of jump because of the TD Ameritrade acquisition. If you can go a little bit down, Joanne. Yeah. Oh, my screen is a little bit funny. Okay. Anyway, I projected sales growing at about 10% and earnings growing at about 11%. The analysts, I think up above there, they were saying earnings, this is Morningstar, said earnings were going to grow at 20.5% and sales going to go at 28%. I think they were thinking about, the absorption or the integration of TD Ameritrade. So pretty high. I wasn't going to go that high. I said 10% for sales, maybe 11% for earnings. Looks okay. All right. Then we go a little bit lower down. It says pre-tax profit on sales. Let me see. It's about 39%. That which is pretty good. It was brought down because of the year 2020. If we cancel that year, it'll jump up a bit. The other interesting thing about this is return on average assets, because Schwab is a bank. And so return on average assets is about 0.99%, which for a bank is actually pretty good. Anything close to 1% for a bank is actually very good. But if we take a look at 2020, we cancel out that 0.72, the return on average assets will jump up to about 1.2, 1.1, which actually is very good for a bank. 1.5 is excellent. It's all very rare. But anyway, for banks are actually, for a bank right now, even including the 2020, that's very good. So that argues for management knowing what they're doing. Okay, can we go to the section 2, Joanne? Yeah, the second, yeah. Oh, I was going to talk about the competitors. Could we go back to the first panel? Yeah, and then go to the compare peers. Charles Schwab is about the smallest player amongst its peers. There's Goldman Sachs, Morgan Stanley, 45,000 sales, 44,000 sales, and Schwab is 11,000. But in terms of historical sales growth, they're not doing too bad. They grew well. I think because of the TD Ameritrade, and that's what a lot of investors were happy about, is that they grew in size to compete with the Morgan Stanleys and Goldman Sachs. That's what really pushed up the price right now. So right now it is a little overvalued, but not as much as it's going to be in the near future. Let's see, historical earnings per share, all that kind of stuff. Okay, it does very well against its peers. Here I put price earnings ratio. The high of average is about 26.5. I didn't really cross out anything because I could even cross out this 2019 about 19.3, but I left it in 26.5. I projected a 26 because when you click this show hide price earnings chart here on the left button, Joanne, yeah, that one. You see the high earnings is about 26.5. The average earnings is about 26.5. This button here, or just the average line, it's about 26.5. So I projected 26, sticking pretty close to the average. And then for low, I think I picked 16. And here on the green line, the average trend line, the average point there is about 16.2. Yeah, no, at the end of that, Joanne, at the right end, yeah, 16.2. That's it. And I said my average was 16. That's as I use that. We can get rid of that now, Joanne. You can hide the, yeah. So 26 for the average high and 16 for the average low, all right? And trading 12 months earnings per share was 263. I had a little discussion with what's his name, Susie Artsberger, because there used to be an option on the old SSG where they would take the trailing, not the trailing 12 months, it would take the trailing 6 months plus the future 6 months earning. So it would tend out to be this trailing 12 months is 263, but if we do trailing 6 months and the future 6 months, it would turn out to be about 275, something like that. It'd be slightly higher. Okay, but it's not a big deal. Okay, so the future high price is going to be $115.2 and the future low price is going to be at 42. Which is and those two numbers there give me an upside downside ratio of about 0.9 to 1, about 1 to 1, but I'm being conservative, all right? Morningstar 23 sales, 28 earnings. I said 10 and 11. So yeah, if I did that, the upside downside ratio would have been higher. It would have been like maybe 2 to 1. So it's doing well there. Okay, where we go? And then, Joanne, yeah, can you go back down to the bottom? So it's in the hold zone right now for conservative kind of estimates. And the total return is going to be about 6 on average, I think. It's going to be like 8.2 and 3.9, about 4, 8 and 4, between 8 and 4 is going to be about 6%, which is, for average estimates, it's not too bad. And then I have other little things I could like to talk about. Schwab, on the news right now for Schwab is a little slow. There is not much going on. The latest thing I picked up was that TD Ameritrade is being TD Ameritrade is being brought to court because in their practice, I think it was before the merger with Schwab, TD Ameritrade introduced one of their corporate investors to a broker. It turns out that broker is running a Ponzi scheme, which was unknown to TD Ameritrade. And so they're being brought to court because of that. But I don't think it's going to go too far. I don't think it's going to matter too much. It's probably be dismissed. Okay, and well, here on this graph here, the sales are going way up, earnings are going up. The slope of the trajectories are almost what they called not parabolic. It's geometric. Geometric, I think it is the term. Anyway, their latest earnings, they beat at the bottom. They earnings per share, they beat by 54.2% on a year-by-year basis, and trailing 6 months, they beat earnings by 21.8%. So everything's doing well. Sales 77% on trailing 12 months. Pre-tax profit 82% better trailing 12 months. But this was because 2020 was a disastrous year. So it's a little bit artificial, and they're coming out of it, and they're coming out of it with the addition of TD Ameritrade. And in their 10K, Schwab was saying that it would take them about 18 months to fully integrate TD Ameritrade. And they took over TD Ameritrade, or closed that deal in October of 2020. We're just kind of, past the 12-month mark. So I think in the second quarter of 2022, and we'll see kind of the real extra push of TD Ameritrade. I read a couple of other little articles that were kind of interesting. They were saying that Schwab, all these discount brokerages, they say, oh, we're going to make our trades for free. But, actually, you're the actual person who holds a trading account, he's actually paying for it. And the way they're paying for it is that the brokerage, whether they be Robinhood or TD or Schwab, those are the two that they were comparing in this article, Robinhood and Charles Schwab, say that Robinhood and Charles Schwab, what they do is they give the trades, they pass it on to a what's it called, a market maker. And this market maker goes out and finds a trade. But the trade is not the optimal trade. Its trade is a little bit less better than what would have been. This is called trading for flow. It sounds better, a transaction fee, but it's not a transaction fee. What they're doing, they're handing over the trade to a market maker who finds a trade which is less than ideal. And so the difference, they split between the market maker and the brokerage house. Now, okay, that's a common practice, right, throughout the industry. But Robinhood, the company that they were comparing to, their revenue or income is dependent, about 70% of it is dependent upon that practice. But Charles Schwab is not that heavily dependent upon that practice. They're only dependent upon 20% of their income is dependent upon that trade. Payment for trade flow. Charles Schwab is a bank. They have 32 million trading accounts, brokerage accounts, but they have something like I forget the number now. 1.6 million banking accounts. They have 2.2 million corporate brokerage pension accounts. So they're making fees on a whole bunch of other things. Not only their trading activities with paying for trade flow. If you want to like in a comparison to Robinhood, which they were comparing to, they say IPO was great, but now it's lost a lot of value. Its price is going down. It says it's not as sexy as it was. Everybody thought it's not growing as quickly as everybody thought. But Charles Schwab is much more stable because it's also a bank. Right. And one of the problems that I had when I did this was that people were kind of split. I looked at one of the value line studies, but the value line study that came out for Charles Schwab was dated October the 8th. Charles Schwab reported their last earnings on October the 16th, which was about 2 days before our last meeting, right? And 2 days before our last meeting, Charles Schwab's last earnings report, they earned 84 cents rather than what Zacks had predicted of 80 cents. So they beat Zacks' predictions, expectations. So that was great. But Value Line didn't know that. Value Line projected earnings of about 10% for sales, 9% for earnings. But that was before they saw Schwab's last earnings report, because they wrote their evaluation about a week before, and they haven't done
Piero?
any. Yeah.
I hate to interrupt you, but we're running out of time, and I want to give the guests time to comment. So we have one more review to do, Vertex. If people have questions for Piero, can you send them an email, or guests, you can wait till we have our question and comment section.
Sure.
Is it okay if we move on to Jane and Vertex?
Sure. Okay.
Thank you very much for your presentation. That was good. Okay, Jane, do you want me to bring up the
share screen, please?
Okay, there you go. It's up.
I haven't received. Where can I see?
The Vertex?
No, I haven't seen the invitation to accept. Oh, can you see my screen?
You want the screen?
Oh, yeah, show my screen. Okay, I saw it.
Okay.
I got that. Can you see my screen right now?
Yes.
Okay. This is a Vertex SSG, and Vertex has a great quarter, mainly not because it's performing well in both sales and earnings, but it's about the pipeline. The pipeline, a lot of products have been emerging with good results. So what I'm showing you here is Vertex SSG first. And when you look at this SSG, then you may wonder how I pick up 14% for sales growth. Basically, I look at the value line, and it has a sales growth of 13.5. So it's about, in line with value line, as well as in line with Goldman Sachs, because Goldman Sachs is also tracking Vertex. And so with that, I determine the earning growth rate based on the preferred procedure. And this is all based on the historical and on a very conservative basis, as you can see. So I got this 10.7% for the earnings growth. And you can see that Vertex on all metrics, return on equity, excuse me, return on equity or the pre-tax profit on sales, they are all on the positive trend. And the best of all is the debt to capital is great. As you can see from value line, there's no debt whatsoever. So I like the company. And even though in 2020 last year, you still have carried a very small debt, but now no debt. So based on 14% of sales growth and 10.7% of earnings growth, I take out 2 outliers, and I come up with a buy. Is the upside and downside ratio is 9.4%, 9.4 to 1, and the annual return on the average. We can go back to PER. So as you can see, that most recent quarter, it's even better than trailing quarter. So that means it's really doing well, both on the sales and profit side, on earnings side. And also on the PE, the average PE for this company is about 29, but then the current PE is only 16. And at the price of last Friday. And as you can see, even the PE growth ratio is also quite reasonable. It's 1.49. So apparently the upside downside ratio is really good. And as I say, it's not about the earnings and sales only. We are looking at other things. So based on the SSG, the average PE, based on average PE, the compound annual return is 15%. And on the high PE is even more than 21%. So what I'm saying here is I'm proposing a buy just because their R&D efforts are paying off, and there are a lot of products in their pipeline, either in the phase 2 or phase 3 stage, and some of them are even ready for to be commercialized. And as you can see from the value line, the price in 2020 last year was even hitting $300. And at that time, why it dropped so much? Because there's a product in their pipeline. It's called VX-A64. At that time, this product had encountered some setback with the FDA, and the FDA has asked for some more data for 2 additional years. So with that, the investors have become very skeptical. So that's why the share price declined from 300, more than 300 to like 100 and even 85 at the time. And now value line, at the time of value line report is 198, and our current price is 186. Even after the market is only 188. So and we go back to the product. Excuse me, the product. We look at, because Goldman Sachs has a very good summary of the product that this company have in their pipeline. And I'm not going to detail because everything is uploaded into our, sorry. Okay, anyway, so if you look at the Goldman Sachs report, you will see a lot of products, as I mentioned briefly here, that they are diabetes 1, type 1. They are kidney disease, products for kidney disease, products for acute pain, and even some genetic diseases. You know, they are addressing serious diseases, and they are all paying off right now, and the future look really, really bright. So you go back to value line. Even value line at that price, about $200, the value line, you know, I mean, I agree totally that why they like about this company. And so we have purchased it. The company has further raised, I think 3 times, yeah, twice. They have further raised to 7.5 billion, 7.4, and this really reflects their confidence, the management's confidence in their growth potential, and also Goldman Sachs, based on their evaluation, they further raised their target price to 12-month target price to 326. And the downside, of course, they are always downsides, but these are the downsides that are not unusual for a biotech company. So I recommend a buy, even though we already have a position of about 6.2%, and our average purchase price is not low. And however, I think with our additional purchase with this good company, not just because the price has come down to 186, but just because it's a great company and the price is right and it's a quality company, and I recommend it buy. Sorry, am I going too fast or too long?
No, that was good. Thank you, Jane. Appreciate your summary. That was great. Let's move on to the guest open mic for guest questions and comments. We'll start with Anitra. Anitra, are you on? Is she self-muted? We'll move on to Brian. Hi,
Just to
Brian.
say, I have no questions.
Oh.
This is Anitra. I have no questions.
Oh,
I have
hi,
to
Anitra.
go to
Okay.
unmute myself. Thank you.
Thank
But I
you.
enjoyed it.
This is
Hi,
Brian.
Brian.
Great discussions tonight. I learned something again, quite a bit, in fact. If you don't mind, I'm going to sneak FNV and maybe Freecore for my next investment club meeting as a couple of stocks to look at. So if that's all right with you.
Great. You're very welcome.
Thank you.
Okay. Emanuela, any questions or comments? I think she's let's see. Emanuela? Oh, is somebody, Jay, are you muting or unmuting? Okay, we'll leave her. I'm unmuting Emanuela. Somehow it keeps getting muted. Okay, Evelyn. Evelyn, you're self-muted. We'll move on to Johnny. Hi, Johnny, you're self-muted. Kirsty Stewart, self-muted. I'm just leaving the self-muted people open. If you come online and have a question or comment, just start speaking and then we'll go to you. Margaret. Okay, Margaret self-muted. Margot self-muted. Mark. Hi, Mark.
Hello?
Hi, Mark. Do you have any questions or comments?
Oh, can you hear me?
It's kind of garbled.
Okay, I'm about to try to put this headset in. Hold on.
Mark, I'm gonna come back to you in a minute. It sounds like you're trying to work out your speaker. Is it working now? Mark? Okay. Patrick? Hi, Patrick.
Nope. Hello, yes. It's the first time joining, so I have no questions or comments just at the moment. Thanks.
Okay.
I'm just taking it all in.
Thank you. Okay, thank you. Philip? Okay, Philip's self-muted. Ron? Ron, you're self-muted.
Yeah,
hi,
no
Ron.
questions. Hi, how you doing?
Good, how are you doing?
Excellent, excellent. No questions.
No comment?
No comment.
Okay.
What?
Sophia, any questions? Hi, Sophia.
Hey there. No questions or comments. I'm just a little bit curious about where it is that the users and the presenters are getting this documentation where they go through this PERT thing and they're kind of putting in some of the numbers and the rationales and things like that. Where's that actually coming from? Is that a resource that you've built specifically for your club?
No, there's a wide range of resources that are used. There's analyst reports. We often with the brokerage accounts, you have access to.
Joanne,
yes.
I think she's referring to the PERT report.
Mm-hmm. Correct. Yes.
Yeah,
Which one?
we put that together. Yes.
Oh, okay.
The My iClub one?
No, the PERT report.
Quarterly report. Quarterly opinion.
Oh, I'm sorry.
If you look in the Jane's screen right now, I think that's what she's referring, right, Sophia?
Yes, correct. That's what I'm referring to.
Oh, that's okay. Yes, that's a document that we've kind of fine-tuned. I think isn't there a template on BetterInvesting, or is that something that we've done?
No, this is
we've done.
No, I put that together. We can send you a copy of it if you're interested.
Yes, I would like that. Thank you.
Okay. Thank you, Sophia.
One too.
Hello, hi. This is Kirsten Stewart. Can you send that report to many other people too? I would love that too, that quarterly PERT report.
Yes, it's excellent.
It's absolutely fantastic.
Yes.
Can you load that in the handout section, Jay, while
Yes,
we're
I
talking?
can do that. We have one for quarterly. We have another one for annual. So we can send it to you for both.
Oh, yes. Thank you.
Yeah.
Just load it to the handout section, and then you can download it.
Okay.
Thank you.
Yep.
Yes, that'd be great. Thank you.
Just
Margaret,
give us
did you
credit
have
when you guys use it. It's for our club.
Oh, okay. Let's see. Stephen. You're self-muted, Stephen. Ting. You're self-muted. Wiley. You're self-muted.
Yes, good. Can you hear me? Can you hear me?
Hi, Wiley. Yes. How are you?
Yes, I'm doing fine. Thank you so much. I enjoyed the presentation on tonight. I have two questions, if it's okay.
Sure.
The first question is, I noticed that everyone suggested as far as what is good to keep and what is good to sell, get rid of at the time. Who chooses the companies to invest in? Do you do that as a company, as a group, or you do that as individuals?
We have a stock study group that does the research and analysis, and then they present it to the group, and then we vote on it.
Okay. And the second question is, do you do the same thing as far as you vote on deciding when to stop investing?
I'm sorry, what was the last part? Do we vote
I said, do you do the same vote as when you decide that you want to stop investing in a certain company?
You mean when we want to sell it?
Yes, when you want to sell it or stop investing in it. I heard one person say earlier, buying more, and I don't know if that meant since that the Facebook profits are steady, so they don't want to buy any more of the Facebook profits. So when you decide that at the time, do you decide as a group when to stop?
Yeah.
We have a investment policy statement, and it outlines certain things. Like, for example, we want to have a minimum 5% of a stock, so it's represents a significant portion of the portfolio, and there's a whole list of things. So when you hear us talk about that, those are probably coming from some of those guidelines. But for everything, whether we buy or sell, it's a vote. And if we want to sell something, we also have a checklist that we typically would go through before we recommend selling something. So we have to check off all the items on the checklist. But we vote on everything.
Okay, all right, good. And last question, I said two, but I got one more. I noticed also that you also said somebody mentioned, and I don't know who was it, but it says the 3 to the 5 year watch. Is that on every company that you all decide that you're gonna invest in or buy? Is there a minimum and maximum of 3 to 5 years, or do you do 5 to 10 years or anything of the sort?
I think, well, ideally, that's sort of a better investing guideline, is that you hold for at least 3 to 5 years. But that's why we do the quarterly updates. If we start to see that company fundamentals are deteriorating and it's an ongoing pattern, then we'll recommend that we sell it, even though we may not have held it for 3 to 5 years.
Okay. All right. Well, that's all the questions I had. I thank you so much. I really do appreciate it. Thank you.
No
You're
problem.
welcome. Mark, I see that your hand is raised. Do you want to do you have a question or a comment? Mark?
Maybe his microphone's not fixed.
Oh, okay. His hand's not raised anymore. Okay. All right.
Okay.
Thank you very much.
I
yeah.
uploaded the two templates, so they are in the handout. I
And that's in the
uploaded in the Word document because I don't have a Word installed. Hopefully the layout is good as the Google Doc. So you may want to test out Joanne because I don't have Word on this computer, so I don't know what it looks like. There are a couple of comments that from Carol Fine before she left to join her own club meetings. She's asking if what's our club performance and compared to index. Actually, we forgot to talk about it at today's Treasurer's report. I was looking at it is cut up performance. Do you want me to give me my screen? I just want to show things already open. Unless you have, do you have iClub open, Joanne? Do you have iClub
open? Yeah.
Okay, you can go ahead and just open it. And
Jay, which report am I looking at?
oh, the index. She's asking what is our club performance compared to index.
Yeah, but what report is it?
What report?
I'm on the
What do you mean?
Can you see my screen?
No, I don't know whose screen is this.
Okay.
Oh, I thought maybe that was on Jane's screen. It's under club performance on the left. Oops. Yeah, there. Under portfolio, and club performance. So that is I think that's what she meant. I thought we have a 5 years Disney. We had a Disney for 5 years. I don't understand why it's not showing here. Regardless, to answer her question, for 3 years, we do better than Vanguard 500, right? Not as well as QQQ Trust, but it's better than Vanguard 500 index fund. I think that's what she meant. Compared to index.
Could you scroll down a little bit?
Are there other index funds that we can choose, or
we could, yes.
Scroll down some more. Right
oh
there.
yeah, go ahead, choose that. Let's see.
This is kind of misleading because you know, if it's based on the size of companies that we own. So if we owned all large caps, you might want to, you know, pick the S&P. If we had small caps, you pick the S&P small cap. So there, it's kind of it's probably worth comparing to a number of these and just see where we stand.
What do you suggest, Henny?
I would look at like how much we own in each category, and then just maybe just pick some that match each of the categories. It's not really accurate, but yeah.
Well, can I make a suggestion?
Yes, go ahead, Pierre.
The Russell 2000. Yeah, iShares Russell 2000.
iShares Russell 2000.
Yeah.
Up.
That's small cap, isn't it, Piero?
I thought it was medium.
Can you change the date, Joanne? Going down one more time. Change the date. Yeah. Say May 1st, 2016. Oh, there you go. You have a second one. Yeah, I think that's good enough. How come we don't have a 5 years? I thought we had a Disney for 5 years.
It might have been we didn't have my iClub.
Oh, you're saying the data did not get imported?
Yeah.
Can you scroll down a little bit? It shows 5 years there.
Yeah, it did.
But it's the same as 10, so which is NA. So I don't know what that means.
Okay.
Carol also had another comment about whether we just simply gloss over the management section. I mean, we don't always.
Yeah, she's right. I was wondering about that. So when we present a new company, we definitely focus on section 2, right? The debt to pre-tax profit, all that. So when we give a quarterly report, personally, I have not really focused on that much. Return on equity, all that.
Yeah, because for a while we were just saying we would only review it if we were suggesting a buy or a sell. But I mean, those are good questions.
Yeah.
But those things are annual. So
Yes, we will look again during annual. So I'm not sure during quarterly, should we focus on or
I
gloss
don't
over?
think it makes sense to look at them on a quarterly basis because they don't change.
That much. Okay.
Yeah.
Okay. Anitra has a question.
Oh, what's the question? I have a question, I think.
Anitra,
I'm sorry.
there?
Yes, I'm here. My question was, before the young lady started talking about QLYS, and I guess I should have wrote it in the comments at the time because it's probably hard to go back now. But there was a gentleman talking. He said, I thought he was talking about QLYS, and he said it was good. It looked good, and I guess I got kind of lost because it sounded that he was talking about it, but then when she spoke about it, it was like contradicting, and I don't know what stock he was talking about. That's my question. But I gotta say, out of every group I've ever listened to, the online group is just great. You guys work so much, so well as a team, and I learn a lot from listening to you, even though I'm still very new and still trying to grip everything. But I like your energy and how you explain things, and I really appreciate it. But yeah, I didn't understand what it was he was talking about, because I thought he was talking about QLYS, and then she started talking about it, and the facts just were different. So I got that. If anybody knows what the gentleman was talking about prior to QLYS or whatever stock he was reviewing before that, please let me know.
What was before QLYS?
Freecore.
Oh, Freecore. I was talking about
Okay.
Freecore. Next one is QLYS, 2 different company.
But it was a gentleman that jumped in between. It wasn't. I don't think it was Freecore because it wasn't a female. It was a gentleman that was talking about it, and he was saying it was really good, and he said it was like a positive review, and then it went to QLYS not being good. So I was like, okay, well, what was he talking about? That was it.
Well, maybe was Chris, did you mention about maybe the CEO died?
Yeah, I did. I brought back up the fact that the CEO retired like earlier in the year. So that's gonna have like an impact throughout this year in terms of like the profit margins, but I think that's an outlier. So I think the valuation is a good thing, but we do need to keep in mind that the reason why some of the values are lower than what it should be, considering the growth, is because of something that happened earlier in the year. Yeah.
Okay,
so you
Chris,
were talking about QLYS.
Yeah, I was.
Okay, thanks, guys.
If I remember correctly, Chris, he did not retire. He took a leave because of took a leave because of his health issue, and then the price got tanked.
Yeah.
And so.
And then after that, he retired because he couldn't come back because of his health.
So he did retire. I thought he just died after
I'm
3
pretty sure
months
he did
after.
die. I'm pretty sure he did die, but
He did pass away.
I'm
Yeah,
pretty
he
sure he
passed
did
away.
pass away.
Yeah, he did. He did pass away very shortly after they paid out all of the money, which they
Yeah.
had to pay him, you know, for his options and whatever. He passed away
Mm,
very shortly after that.
mm.
Okay, we have another question from Mark. I think Mark's microphone isn't working. His question is, how do you handle tax liabilities by being from different locations? The same with the OKI Investment Club. Is the entire club taxed based on location of each individual? Mark, we use virtual money. We don't. That's the reason why we, because of currency exchange and taxes from different countries and states, we don't deal with actual money, so we don't have tax liabilities with our club. So I hope
Our
that
goal is learning. Yeah, our goal is educational, is learning. So we don't want to spend so much time on taxes and finances, individual finances.
that we ask everybody to manage their own personal portfolio. I hope that answers your question. Go ahead. Oh, that's Mark.
I think,
You want
yeah, his mic. You can type it up, Mark.
All right. Can you hear me?
Oh,
Yes.
okay.
Hi, Mark.
Yes.
Can you hear me?
Yes.
Yes.
Oh, okay. Well, is it since if a club did get together with people from different locations, like different states, you think that would be like a tax problem, a tax issue?
Yes, there is definitely. I mean, there are clubs that don't let you join them because if you're from a state that they can't handle the taxes. I mean, that's only when you have a club that actually every member contributes money. So
Investing real money.
yeah, if you invest real money, then you're going to have to manage the taxes.
We don't invest in real money.
And it can get very complicated if you have people from different states.
Okay. Okay.
Okay. Do you have any other comments or questions?
No, that's all.
Okay. Thank you, Mark. Okay, so we're going to quickly move on to, oh shoot, we have like 2 minutes. Let's see. Okay, I don't know if we have any buys or sells. I don't think so this month because we have to, Tom Loftus and Narinda have withdrawn from the club. So we need to pay them out. I think Reddy will manage that. I think Narinda has about $300 and Tom Loftus has about $1,500. So we have enough money in cash to pay them out. So we'll have to look at the next month if we want to buy or sell next month. And now so Hanny already said he would be the follower for Amazon. Is there anybody that would like to follow Google? If nobody says volunteers, I'm going to assign. Oops. And the way I assign is if first it'll go to,
Does everybody have a stock?
Sorry?
Does everybody have a stock that they're following?
Yes, everybody has a stock. So this,
Joanne,
yes.
you should remove that screen.
Oh, sorry. Okay. Thank you, Hanny. So the way I identified members is if you had held an executive position, or like the first people to get assigned will be people that haven't held an executive position, have an executive position now, who haven't done any kind of contribution to the club, so they'll be assigned, and that would probably be Nagumi and Piero. So, Hanny, do you still want to follow Amazon?
No, if you have others, that's fine. I'm okay with that.
I might have you be a peer reviewer for like Disney or iRobot.
Sure.
Is that okay? So Pierre Megumi or Piero with Amazon or Google?
Take Google.
Okay, I'll take Amazon.
I thought that the way you assigned is like for people that are not in the meeting. That didn't bother to show up.
So that would be Matt. Who else?
I think that would be a much better approach.
I know. Okay.
I mean, that's why I hung around. It's 10:30 my time.
I can be
Okay.
peer reviewer for either Disney or iRobot.
Which one do you want to be?
Either way.
I hate Disney.
Oh, okay, that's good. I was just going to say because I used to follow Disney, so
You
sure.
Did you
Oh,
say
he
you hate
hate Disney? That's what he said? Henny, you say you hate?
Huh?
Oh, what did you say?
I said I hate Disney. I would sell Disney.
Oh.
Oh,
The reason I said, okay, I could follow the peer review Disney, but I was the follower for Disney. So
that's okay.
okay.
If we get new people, this is like temporary assignment. If we get new people, we'll reassign.
I can
So
be
Hanny,
peer reviewer or any of it. Just give me one, iRobot or Disney, either.
Okay. For the education assignment, Matt did a whole survey. I don't know, does anybody remember this? Where he sent out a survey and people voted and he gave them scores.
Yes.
Do we want to assign topics or do we want to, I think it should be a lot easier. If you attend like I did, a ticker talk or a subject that you want to do, a webinar that you just want to do a quick review on, educational piece.
Also, I have another suggestion. I said, okay, we're all getting Better Investing magazines. We are too busy to read them.
Oh, yeah.
So if anybody read a good article for the current issue, we can also share the idea.
Because I think Hanny said he wanted 6 months advance notice to work on something. I think we shouldn't make it that difficult. It should be an easy piece to research and to share with the club. I mean, of course, if you want to do something more.
What I said was that we should plan the education topics at the beginning of the year, so we know when they are and who's doing them, and that way people have a long lead time, and we also know what it is that we're going to be talking about.
Sure, we can do that. Okay, so maybe that'll be at our December meeting. That'll be a topic of discussion so that by the time January rolls around, we know what education topics are going to be. Okay, that's the education. Now, are we ready to vote on the motions or people need more time? Hanny said he couldn't find on Slack the discussion area.
Operating procedure motion. I don't remember that one either.
I think Mahesh made comments, but there wasn't like a discussion amongst like the club that I could find.
Okay, so this was the motion. I don't know if anybody read it.
Oh, yeah, there is motion. Okay, now I see it. Okay.
Do you need more time to review?
I think I said it in the Slack thing, like if we vote for it, I mean, it just seems like it should be an evolving document. We shouldn't have to wait a year.
It is. So the motion, upon motion approval, create a meeting management policy document to be reviewed annually or to be updated as needed.
Well, that's the part I had issue with, was annually. We should just update it as needed.
Okay, so we can say up to be reviewed and updated as needed. I mean, that's why I wanted everybody to, let's see, I can't.
I made that comment in the Slack.
Okay, perfect. That's perfect. I don't know, do people still need time to review this?
No.
Any other comments? Okay. Okay, so the motion is agree to create a meeting management standard operating procedure, providing guidelines for club meetings. The policy to be reviewed and updated as needed. Okay. So we ready to put this motion?
Sure.
To vote?
Yeah, you're going to copy it and put it in my iClub?
Sure.
Or how do you want to do it?
Yes. All voting should be documented.
Yeah.
So agree to, okay. So last time we made the mistake of using this default closed voting if all members have voted and set the date. So we want to close voting if majority is reached. Oh, anybody who's making the motion? I guess I'm making the motion. Anybody seconding it?
Sure.
Any? Okay, simple majority. Notify members when voting is ended. Okay. The second one is the add advisory role to articles of agreement motion.
I thought we're not going to do that.
No, we have, since it's
We're
already
gonna vote
been,
on it.
we were going to vote on it.
But then there's no motion, right? If people not agree that.
I think she's making a motion.
Oh,
right
okay.
I made them up. Well, yeah.
I see. I see what you're saying.
Okay. I guess if nobody seconds it, we don't have it then.
Yeah.
Nobody wants.
Because there's.
Okay.
I just felt like the motion died.
Okay.
I
Motion
don't know
died.
if it
Okay.
is.
Okay. Motion died. Okay. I'm just going to say motion died. Okay. All right. Last month's motions. Sell shares of DPZ passed and buy 27 shares of LGIH passed.
Are we going to trim Facebook?
Yeah, so there were 3 suggestions made. One was to trim Facebook. One was to buy more Franco-Nevada and Biomarin.
And Jane wanted to buy
Biomarin.
is that what it was?
No.
Vertex.
Vertex.
Sorry.
It's
Yeah.
unfortunate that Tom's not here because it depends on our portfolio, right?
Well, it depends on. We got to pay out Tom and Narinda to see how much cash we have to buy.
We have a $2,900.
Yeah, but then if we're going to add 13 and then we're going to subtract out, I think, about 13, right?
Okay, so I think we should capture those 3 suggestions, and then once Reddy does the math, and we're gonna have money from this meeting, right?
Mm-hmm.
Yeah,
I captured. I know exactly how much. For Tom and Narita, we just need $1,800.
Okay.
We have 3,000, right?
Yeah,
Hanny,
795. So about
and then plus 1,300, so we have about 2,500 to spend.
Yeah.
If we want to go to zero, if we want to be fully invested.
Hanny, can you repeat what the recommendations were?
Megumi suggested that we possibly trim Facebook. I don't know if Megumi, if you want to make a motion. And then I suggested we buy more Franco-Nevada, and Jane suggested we buy more Vertex.
Yeah, so I think as far as Facebook, I think last meeting we decided that we were going to wait and see what Disney did, how Disney performed. And then make a decision on selling Disney. Because if we sell, I mean, Facebook's a good value right now. So if we're gonna, when is Disney's next?
Next annual, I think.
Annual next month. Annual report next month.
So if we got rid of Disney, what does that do to our large our size diversification? Let's see.
We have a 15% Facebook, 10% Disney, IIPR 14%.
No, but size wise.
Oh, size. Okay, let me look.
Yeah, because we were way over on the large size. We have like 40%, I think, and
Mega. Okay, Disney about 14%, and sorry, Disney is 9.3. Facebook is about 14 size wise. Oh wait, oh, no, that's the number of a club. Oh no, I'm sorry. Mega. Let me take a look. I looked wrong.
so large is 9.4 and mega is 33.1. If we got rid of Disney, which is 9.3, that brings our large company to 33%. Of our, so about a third of our portfolio. We want to be at 25, right? I don't know, but I hate to sell Facebook if Disney's going to be a good time to, if we decide we're going to sell.
The other thing is we can trim Disney.
Okay. Yeah.
Because what did you say? It was like 10% or 9?
Yeah, 9%. 9.3.
So we can trim both Facebook and Disney to bring them in line.
Okay.
And Algonquin Power is 6.9%. IIPR is 13 because it went up quite a bit.
And they're small. They're small, so we want to keep.
You want to keep those.
IIPR.
So yeah, there's like opportunities to maybe trim and then generate enough cash to buy.
Yeah, I guess the only thing, and I'm not pro Facebook, but the price is down right now. It's a good opportunity to buy, but I'm good with selling too.
No, I think, yeah, that makes sense though. If Disney is going sideways.
Is it?
Facebook is down. Disney's going sideways. So you could trim Disney.
Is Matt here? Is he following? He's Disney follower, right?
Matt is not here. But then Joanne, you recently at the webinar learned about Disney. What did you say about Disney from Craig Kramer about the mold or something?
Oh yeah, gosh, I wasn't paying attention. Sorry. I think it's that Disney has a wide moat. You know, that was a webinar on trimming stocks. If anybody's interested in that, that's a Disney has a really, and he said like only, I think, I don't know, it's a very small percent of Morningstar stocks that have a wide moat, and those are the stocks that you want to invest in because they're hard to compete against.
So does Facebook have a wide moat? Probably. I just hate selling when the price is down.
I know.
It's gonna come back up, I know, but
well, what we can do is that we don't have to sell tomorrow. We can, wait. We say we set a price, not market, make orders. Say if price is the 350, let's sell 5% or 10 share or something like that.
Limit order.
Limit order. Yeah.
Okay. Can we do that? Okay, we can do that.
What is Facebook's price right now?
Okay. Can we set this buy and sell for these 3 stocks for next month?
Yeah.
We can.
Okay.
There's no rush. We have the money. Yeah.
Except
so we know
I think
what our
VRTX, I think, is a good buy right now. If we're considering buying, Facebook we're considering selling, so I don't mind waiting. But what do you think, Jane?
I think it's a great price to get in further.
You don't think it's going to go down more?
Even if it will go down more, it will not be too much more. I think we
Okay.
are looking at 176, right, for the lowest, and that's before they show the bright future for all the pipeline development. So that will be the bottom. The bottom.
I think we should buy what we're considering buying if it's a good
Right.
price. You know, Facebook we can sell later when the
So
prices
can we
goes up.
buy enough to bring it up to, I mean,
5%.
yeah. Do we have enough money?
We have $2,500. So,
No, the Vertex is already over 5%.
oh yeah, so is Franco Nevada.
Oh, sorry. Yeah.
Is it? Oh, okay.
Yeah, we were at 5.3, 5.3.
Oh, okay.
And then
Then go
Domino's
buy
in there still, so I don't know.
Why is
Then
that one
go
still
buy
there? It should be
I'm not
still
sure.
okay. We need to fix that iClub.
Okay.
So,
Do you guys subscribe to CNBC Investing Club with Jim Cramer?
no.
No.
No, I don't listen to him anymore. Yeah, he was entertaining, but
It's free.
yeah.
You don't have to pay anything.
Okay, how do you?
I'm gonna send you a thing that he has on Disney.
Okay.
I'll send it to everybody. Hold on.
So if Matt says sell Disney next month, we can also trim Facebook at the same time.
Yeah, I personally I wouldn't sell Disney. I think it's a good company in the retirement account.
Okay.
This is what he says. First off, Disney is much more than a streaming company. We are very bullish about the theme park recovery. Second, we believe Disney has some of the most valuable intellectual property in the world, whether it's be through the ESPN and sports gambling, Disney Plus, and the role it will have in the Metaverse. Or something we're not even thinking about. Disney has plenty of levers it can pull to unlock value.
So why do you hate it so much, Hanny?
I don't know, it just hasn't done anything. Just been trading sideways.
Well, they just come out from COVID. They are still,
Yeah, I know.
yeah, not fully opened. The parks.
Okay, so we need to move along here because we've already gone over. Are we going to hold off on Vertex and Franco Nevada? Or do you want to buy?
If we have 5%, I think that's okay.
Okay. We can discuss this in December, but for people who, for their own personal portfolios, it might be a good opportunity for them. Okay, so this is a reminder that the December meeting is the second Monday, not the third Monday.
Oh,
I'll make sure to.
hold on.
I'll make sure.
Oh, really? Okay.
Yeah, I'll let Megumi know. So a week before.
Well, it was weird that November had 5 Mondays in it. It's
I
usually not
know.
like that. So I was like, and then some of my other meetings got moved around because of the holidays, so I got confused. Sorry.
Okay.
So it's actually December. When is it? I'm gonna do it now.
December 13th, Monday, December 13th. Okay. All right. I am going to stop the recording and adjourn the meeting and stop the recording.